Hello and welcome to the channel. There's something incredibly appealing about the idea of dividend investing, isn't there? The notion that companies will just send you money, quarter after quarter, simply for being an owner. It sounds like the ultimate passive income dream. It feels safe, predictable, and real, but is this dream a bit too good to be true? Is dividend investing a reliable path to wealth, or is it a seductive trap that can lure you into making terrible decisions? Well, the truth is, it can be both, and understanding the difference is what separates the successful investors from the disappointed ones. In this video, we're going to cut through all the hype and the fear. We'll explore the powerful benefits of dividend investing, expose the common and costly traps, and give you a clear framework for building a smart, sustainable dividend strategy. So, let's dive right in. First, let's be absolutely clear, dividends are not a scam. They are a very real way for companies to share their profits with their shareholders. When a company makes a profit, it has two main choices. It can either reinvest that money back into the business to fuel more growth, or it can distribute a portion of it to its owners, that's you, as a dividend. The real magic of dividends comes from two powerful forces, income and compounding. First up, predictable income. In a volatile market, seeing that dividend cash hit your brokerage account provides a huge psychological and financial cushion. It's a real return, no matter what the stock price is doing on any given day. This is exactly why dividend stocks are so popular with retirees. They can generate cash flow without having to sell off their precious shares. But second, and even more importantly, is the power of compounding. This is where the real wealth-building magic happens. When you take those dividend payments and use them to buy more shares of the same stock, you set a powerful feedback loop in motion. More shares mean you receive larger dividend payments next time, which then allows you to buy even more shares. Over decades, this cycle of reinvestment can account for a massive portion of your total returns. It's a silent wealth-building machine working for you 24/7. Think about it. Companies that have a long history of not just paying, but consistently increasing their dividends, often called dividend aristocrats or dividend kings, are typically high-quality, mature businesses with incredibly stable cash flows. So, by focusing on these types of dividends, you naturally start gravitating towards financially sound, reliable companies. Now, let's talk about where investors go wrong. The single biggest trap in dividend investing is the siren song of a high dividend yield. This brings us to trap number one. The yield trap. The dividend yield is just the annual dividend divided by the stock's current price. So, a really high yield might look tempting, but it can actually be a major red flag, not a green light. Why? Because the yield goes up when the stock price goes down. A sky-high yield often signals that the market believes the dividend is at risk of being cut. If one company is paying out a 10% yield when all its peers are paying 3%, it's usually because that company is in some kind of trouble. Chasing that juicy yield can lead you to pour your hard-earned money into a sinking ship. And when the company inevitably cuts its dividend, you get hit with a devastating double whammy. Your income suddenly stops, and the stock price collapses even further. Next is trap number two, ignoring total return. This is such a critical concept to grasp. Your total return is the combination of the stock's price appreciation plus the dividends you receive. A company can pay a great dividend, but if its stock price is stagnant or falling, your total return will be poor. On the flip side, a fantastic, innovative company might pay a small dividend or even no dividend at all, but its stock price could soar, leading to incredible total returns. If you only focus on the dividend income and ignore how the share price is performing, you are setting yourself up to underperform the market big time. And finally, trap number three, the tax inefficiency. In a normal, taxable brokerage account, dividends are typically taxed in the year you receive them. This creates a tax drag that slows down your compounding power. Now, compare that to a company that reinvests all its profits for growth instead of paying a dividend. This growth-focused company might allow you to defer paying taxes until you actually decide to sell your shares, giving that money much more time to compound tax-free. For investors in higher tax brackets, this is a really significant consideration. So, how do you actually harness the power of dividends while skillfully avoiding all of these traps? The key is to build a strategy that's based on quality and sustainability, not just a high yield. Step number one, look beyond the yield. Instead of just searching for the highest dividend yields you can find, you need to search for these key metrics. First, the payout ratio. This is the percentage of a company's earnings that it pays out as dividends. A payout ratio below 60 or 70% is generally considered safe. It indicates the company can comfortably afford its dividend and still have plenty of cash left over to reinvest in growing the business. Next, look for dividend growth. A company that is consistently increasing its dividend year after year is a much stronger signal of financial health than a company with a high but static yield. You want to see a proven history of annual increases. And of course, look for strong fundamentals. The company behind the dividend still needs to be a solid business. It should have a competitive advantage, what Warren Buffett calls a moat, and healthy, predictable cash flow. Step number 2 is to diversify your dividend sources. Don't put all your eggs in one basket or even one sector. Different sectors are known for paying dividends, like consumer staples, utilities, healthcare, and energy. But they all have different risks. If interest rates rise, utility stocks might suffer. If the economy slows down, consumer staples might hold up better. The best approach is to own a diversified collection of dividend-paying companies across many different industries. And honestly, the easiest way to do this is with a dividend ETF, like SCHD, the Schwab US Dividend Equity ETF, or VIG, the Vanguard Dividend Appreciation ETF. These funds do all the hard work for you, selecting a basket of companies with strong dividend histories and solid fundamentals. And finally, step number 3, choose the right account. To maximize the tax efficiency of your dividend investments, try to hold them in tax-advantaged accounts like a Roth IRA or a 401k. This allows your dividends to be reinvested and compound year after year without that annual tax drag slowing you down. So, what's the final verdict? Dividend investing is a fantastic, time-tested strategy if you focus on the quality of the dividend, not just the quantity. It is a strategy when you buy wonderful companies that just happen to pay a sustainable dividend. It becomes a trap when you start chasing high yields from shaky companies, sacrificing your potential for total return for a false illusion of safety. Let's do a quick recap. The strategy: dividends provide reliable income and powerful compounding when they come from high-quality companies with sustainable payout ratios and a history of growth. The trap: chasing unsustainably high yields, ignoring total return, and creating tax inefficiencies will severely hurt your long-term wealth. The smart path: focus on dividend growth and fundamentals, diversify your holdings, possibly using ETFs, and always be mindful of your account type to be tax efficient. Dividends aren't free money. They are a portion of a company's value being returned directly to you, the owner. A smart dividend investor understands this. They choose companies that are so strong they can afford to pay you today and keep growing to pay you even more tomorrow. Don't just chase the paycheck, invest in the company that can keep signing it for decades to come. Thank you so much for watching. If you found this helpful, be sure to hit that like button and subscribe for more content. See you in the next video.